Good morning. Good morning. Welcome back. Today is episode 59, and we're going to be talking a little bit more about data in financial planning. I'm joined by Robert Pritchard. Sorry for that. Almost pressed the wrong button here. Robert Pritchard, and also by Richard Schwickkard from Iress. And looking forward to continue our discussion from last week. So last week in episode 53, we were talking about data and sort of, why it is important and laying it as the foundation. And, we made the analogy to building a house that if the foundations are not right, then cracks appear later on. And so we spoke about a whole lot, loads of stuff. And I'm going to be doing a quick summary just before we get into today's session. But first off, welcome. Very nice to have you all back with us. Thank you very much for being here. If you're watching the recording as well, welcome to you. Thank you very much for joining us. And thank you very much for saying hi in the chat. Luckily, the chat is working today. The day before yesterday, when was it on Saturday, it didn't want to work. But that's how the technology goes. So this morning, we've got Terence saying, good morning. Terence, nice to have you back, my friend. Kobus is in the house. Kobus, Elmin Lottering, myself said good morning. Denise, good morning. Kevin, and let me just scroll down here. So we've got Rizan. Nasai Malani, welcome. Lekker. I think it's the first time I've seen you here. The first time you've said hi. And then Stephen and Renee and Malcolm and Gary saying hi. Yes, Malcolm, we are short 3. We're on 397. So we're almost to the 400 mark for the subscribers on the YouTube channel. So thank you very much to everybody that subscribed. Kuketsu and my old mentor, Chris Roo. Chris, welcome. Nice to have you here. Very, very happy to have you with us this morning. And I hope it's going well down in Cape Town and that everything is great. And over on LinkedIn, I've got Amanda saying hi. Good morning, Amanda. Nice to see you. And thank you very much for joining us. And Tinus, ek wil nie weet hoe koud is dit in Bloemfontein vanoggend nie, want here in Joburg, it's getting cooler and cooler. So, tomorrow, I've got another guest on the show. Tanya Kunze is going to join me. And she's really a phenomenal lady. And we're going to be setting out exactly what we're going to be talking about. But it's going to be around living a life of abundance and through the power of positivity. So it's going to be around that subject. So have a look at, we'll be sending out everything on LinkedIn and on email today. So have a look at that and join us tomorrow morning at 8 a.m. for my discussion with her. I promise you it's going to be fantastic. She's a phenomenal lady and very lively and all of that. So with lots of experience and things that she's going to share with us. So really a session that I'm looking forward to a lot. Alrighty, so this morning, as I said, I've got back with me Rob and Richard, and we're going to be continuing our discussion on data and the importance of that in financial planning. So obviously last week we said, well, let's just understand where this discussion fits into the picture, because that is extremely important so that you don't think like, oh, but this is all that it's about. This is just like when we do the financial planning itself and we're doing analysis and all of that kind of stuff, it's important to have the right data, because if you don't have the right data, one, the outcomes won't be in line with what it should be. And, later on, it may not be an issue now, but later on that may become an issue, and it probably will become an issue. So that is why we said, the foundation of any financial plan is like the foundation for a house. It's the data and how important it is to do that. And then we got stuck into the discussion around assumptions and how important it is to use, realistic and reasonable assumptions, and how you actually determine those assumptions. How do you get to an answer, and where you shouldn't necessarily just be using the stock standard 10 and 6 or 10 and 5 or 9 and 6 and whatever it is today, so you got to have a house view. Very, very important from that point of view. So today we're going to continue the discussion. We're going to get a little bit more into the actual, what we require in order to do the financial planning. So we're going to be talking about assets, liabilities, income and expenses and so forth. So it's my privilege to welcome back to the show, Rob and Richard. Good morning, gentlemen. Welcome back. Nice to have you with us this morning.
Morning, Francois. Morning, everyone. Thanks for having us.
I'm really excited to get into today, because a lot of the things that we're going to talk about is really these are things that we come across in practice, and that when I personally see people struggle with some of the concepts around it, and how to include these things, and should we include it, and where do I get the information, and all sorts of stuff. So I really want to get going in terms of this and to start into this discussion around assets and liabilities and really what that is about. And I think, the big thing about assets and liabilities, Rob, is that, there is probably going to be capital gains tax implications. So for us to really determine that correctly, and I've said this many times, that you can't ignore CGT. I mean, you can, practically you can, but you shouldn't, because the impact of CGT is so huge. And I think we also had this discussion briefly last week where we said, you know what, in the beginning when CGT came out, there was a year, 2 years, 3 years, 4 years, and it didn't have that much of an impact. But now we're like 19 years later. So the impact can be quite severe. So you have to have that. But to be able to calculate the capital gains tax and that, there's certain information that we need regarding each asset. So, let's talk a little bit about that and what are the things that we need to consider in terms of assets and liabilities in that regard.
Thank you, Francois. So absolutely. I think for many people now, certainly as you said, 19 years on, a lot of people have moved their assets, turned them over a number of times, and we probably don't come across an awful lot of people that have got assets predating 2001. But most certainly, if one does have customers in that space, one needs to give careful consideration, obviously, to the method that is used. I mean, as most of your guests will know, if the market value was not lodged with SARS back in 2001, I think it was extended for a period of time into 2002, but can't remember. Then market value is off the table if it's not lodged. And one then needs to obviously fall back to methods such as the TAB method, or alternatively the 20% rule. And if one looks at this, I mean, fortunately, SARS does make the TAB calculator available on their website, and you can actually download it in Excel format. So what's pretty useful is being able to do that. But the detail that is required can be a little confusing. It's certainly quite a lot of data that is needed. What did you pay for the property? How many years did you own the property prior to 2001, post 2001? What improvements were made before? What improvements were made after? And whilst one can obviously get calculators that will perform the actual calculation, it's pulling all that data together. Does the client have the right records? Does the client know even where it is? And funny enough, I had a personal experience exactly along those lines, not myself, but with my mum. My father passed away 5 years ago, and my mum sold the primary residence just over a year ago now. The sale went through, and she was in a bit of a tiz in terms of what to do, where to get the money, and eventually she found a document that proved that my dad had actually lodged the market value with SARS. But it took her quite some digging to go and find it. And of course, what we're seeing in the market, what the worst thing that we can see in the market is if we go, no, it's just too hard to find this data, let's just make an assumption. The calculation of base cost is very key, especially with the length of time that people do own assets. The higher that we can get the base cost, the smaller the gain, the resultant gain. And you've also got to take into account things like your disposal costs, and then of course it starts getting more technical. Your primary residence, is the land greater than 2 hectares? Do you run an office from home? Have you proportioned a tax deduction against the home from an office perspective? Does that have an impact therefore on CGT in terms of your primary residence, and so on? So what I think we should all be looking for is that this is a lot of information obviously to remember. And the last thing that we want is to get to the crux of trying to produce a calculation and suddenly finding out we're missing a whole bunch of numbers. So, a solid database is good, because you'll often find that the fields are there to prompt you as to what you need. What did you spend on improvements on the house? As I said, what were disposal costs, or whatever the asset may be for that matter. And if you can collate the information correctly, it certainly makes a big difference going forward. We spoke last week a little bit about the Pareto principle, the 80% preparation, 20% perspiration, or if you can reverse that, 20% preparation and 80% lots and lots of perspiration and sweating to get the right results. So it is a complex space. There's a lot of information that's required. Very important number in planning.
But also, I'm just sitting here thinking now that what is important, and this is where, I'm thinking about this, and like maybe some people will go and say, you know what, man, maybe let's not get to that level of detail. It's not that important. But now I'm sitting here thinking like, but do we get like the amount of value that we can add through these discussions? Because if somebody does have a property that they purchased before October 2001 and they can apply one of those 3 rules or one of those 3 methods to calculate the base cost, there are certain things required for you to be able to use that, because the overall rule says you can use the highest base cost of the 3, which is great. But if you don't have the documents to support your numbers, then you can't use the TAB method. If you don't have the market valuation, and it was extended until September 2004, if you didn't submit it, then what would have happened is that you can't use the market value. So the only thing you're left with is the 20% rule that you can always use, because it's based on your current market value and the way that they would calculate that. So one, we need that knowledge, and then 2, if you can say to someone, but you need all of these things in place, can you see here that the TAB method is going to give you the smallest gain because it gives you the highest base cost, but you also need the documents, and let people get those things in order before they need them, because that's the challenge. Once you pass away, to listen to like your mom had to run around and find this document, and they don't know where to start. They don't know where to go and look. And then often SARS is in the better hand or in the better position, and they get more that they shouldn't have. So I think there's a lot of value. It's just my point. There's a lot of value in having this discussion and asking for the information and whether things are actually in place. Richard, in terms of the sort of overall usage of this, I don't know, are there any sort of stats just in general about how many people are actually taking CGT into account and how often that is used in the tools? I don't know. Is that something that you can see on your side? I'm just wondering.
Not particularly, Francois. The one point I will make is that some things people don't consider is the ongoing CGT that happens within your asset. And that when I talk about that, I mean your drawdowns. So you've got those ongoing CGT events that are happening throughout the projections, which do have a material impact. And if the guys aren't aware of CGT or they're turning off CGT, that's going to have a material impact on your plan. So other than what Rob's already said and the ongoing CGT on drawdowns and that within an asset, there isn't much that we can point to in terms of specific data that's being inputted and that sort of thing. Obviously, with an X plan, we have ways to turn that off. And there's ways to turn it on with all the relevant data. But from being able to pinpoint stats, and it's quite difficult.
Okay.
It's an interesting question, though, Francois, if I can just add to that. Yep. We actually, and whilst the objective here is not to promote Iress specifically, we have a massive emphasis on data and data management within the larger group. And we acquired a company in Australia just over 2 years ago called Lumen, and brought that into the group. And their first and foremost priority was assisting advisors in terms of the Royal Commission of Inquiry, which was looking at advisors that had been offering, let me rephrase that, advisors that were receiving trail commission or ongoing fees, and actually battling to prove that they had provided any form of meaty service and support to that customer. And whether that is in the form of review or documentation or whatever, I'm not going to debate that, but it's a very big issue in the Australian market, and providers are having, financial planners are actually having to repay millions of dollars to providers because they're not able to prove what they've been able to do. So understanding data and being able to manage data is very critical. So for example, we definitely, like the question you posed to Richard, we get requests in the larger corporate markets and big enterprise customers to be able to interrogate their database and give them meaningful statistics in terms of what level of data capture have they got, what's being used the most, what don't they have in their database, and that we can actually get into some quite deep diving into financial planning, the data that is used, etc., to give a good indication as to what consistency do you have within your business across advisors and so forth. So these are definitely things that are possible to produce.
Okay, no, that's interesting to hear, and that's the thing, that's where data is going to go way beyond just the financial plan itself. I mean, there's a whole host of things why you would want as much data, and also one thing that I just want to throw in here quickly at this point is that, you know, often you find that people want to go on this project of cleaning up their database, you know. So the question is, why do these things get like that? You know, looks like a teenager's room. How does that actually happen? I mean, where are we going wrong? I mean, is there any answer to that?
I'm not sure that there's an answer. We just get a lot of requests to help, and it's consistent across a variety of customers, from the large banking institutions right down to the smaller 1 and 2 man shops. I suppose it's like spring cleaning a house at the end of the day. We just pile up stuff over time, and eventually we need to go back into it and go, let's understand just what we've got in here. And you know, that actually brings me back to one of the reasons that we approached you with the view of saying, you know, what value can we look to add to the market at this time? It's a great opportunity to do a bit of spring cleaning in the database as well, and understand what's in there. Is it still relevant? How should it be used? Do I need to keep it for audit purposes in the future if ever I'm asked, and so on? But at least, how do we clean that up and really get ready to hit the ground running when hopefully lockdown eases? There comes level 2 eventually, hopefully.
Yes, like you want to keep your data locked down, but we don't want to be locked down. Anyway, Richard, no. So tell me, I mean, is there sort of a good way to go through like such a spring clean exercise? I've got my view about it, but is it something that once a year we should sit down and say, okay, this month we just spend on cleaning up our data and checking whether everything is still fine and checking in with clients, or what do you think is the best approach to sort of keep your data up to date?
Yeah, look, my personal opinion, Francois, on that is that I think you need to have it needs to be part of your practice management. You need to, at least once a year, depending on the clients, if you're seeing a client regularly and you're updating their data regularly, then it's not a problem. But it's those clients you don't review often, and that will come up every so often, then you're not ready for it. If you know you've got clients that you haven't touched on in a while, you need to go back and have a look at that data and see that it's all there. I mean, it opens up opportunities. You know, if there's old clients in there that you're reviewing your data, and it's like Rob said, it's a perfect time to do it, where the face-to-faces are less. You've got more time to actually do this, to go in and look at your data and look for opportunities where you can review people, and just sanitizing it.
And
yes,
I'm actually looking at a question here at the same time from Schwickkard. I hope I said that correctly.
Yes, that's correct.
Asking about ongoing drawdowns. Do the planning systems keep a record of daily asset fund prices? Now, to add to what Richard's saying, I think it's key that if we're looking to do cleanups of data and spring cleaning, and where do we get the data, we want to automate as much of that as possible. And whether that means Astute, and for those in the know, Astute are moving into employee benefits. I think Momentum and Sanlam are, Momentum's up, Sanlam's not far away on their EB side. And the other big project that Astute's got on the go is expanding into the transactional investment space. Now, we already offer a full transactional investment data feed into one of the Xplan modules, but regardless of that, I think what you've got to be looking at is the source of the data. Is it coming from the Mancos directly? Is it coming from Morningstar? Who's providing what in terms of that data? What is the Astute feed going to look like? Is that transactional information sufficient for you in terms of your needs? Now, obviously, those needs varied in terms of the type of planning that one is doing, but certainly from a collection of data, one of the key things in terms of trying to collate that information is the underlying asset classes. You can imagine if you've got a preservation fund sitting on a list platform that's got 8 or 9 underlying unit trusts. What's the asset allocation of that investment? Now the list may well provide that to you, but if you've got to do that manually, that means interrogating each underlying unit trust, understanding the weighting of those unit trusts in terms of the larger investment, doing a weighted average calc, and that gets time consuming, not the easiest thing in the world necessarily to do. Look for a piece of software that can handle it for you. But those things are key, because when you're looking at any form of data in the investment space, investment assets are complex. Are they local or offshore? Lots and lots of money going overseas. Maybe not the greatest time at whatever we are sitting at to the pound, 23 Rand or whatever it is. But we've got a lot of requests from companies now, or from financial planners in larger investment spaces, where they're saying, guys, we've moved these assets offshore. They're never coming back. And my answer to them is, that's perfectly fine. We don't need you to bring them back. But we have to understand them, because where does your client hang his hat? They're still a resident from a taxation perspective in South Africa. So it's key that we understand the makeup of the asset from what is the growth component? What are the income components of those assets, so we can calculate residence-based tax correctly, because we're pulling everything back. You don't need to bring the asset back. So as Richard was mentioning earlier around the regular, the CGT impact of regular drawdowns against assets, how do we manage that? How do we understand that? Do we draw down against those assets? Well, whether you want to draw down against them or not is a choice. But tax, unfortunately, never a choice. We can try and minimize it, but that's about all we can do. So it is important that we understand this whole makeup.
Yeah, and it's important. I mean, you're talking about investment assets. So there are different kinds of investment assets. I think the first thing that we default to is obviously like an investment. It's an endowment or a LISP or a unit trust, or something to that effect. But you can also own hard assets that are investment in nature, and you can own property that are investment in nature. And do we include that? Because you also got something like fixed assets. So should one make a distinction between what is my fixed asset and what is my investment asset? So I've got 2 properties, for instance. I've got my primary residence where I live, and then I've got 2 properties that I rent out. Should I classify those separately or differently, Richard? How do we go about that? What is a good practice to follow?
No, you absolutely need to separate those out, Francois. And for many of the reasons Rob's mentioned about asset classes and the makeup and being able to draw down from those assets, you need income in a given year. You can't exactly go sell a portion of your house to subsidize that income. You need an investment asset to be able to draw down from. You've got a number of different bits of data that sit in a primary residence that are very different to the bits of data that sit in an investment asset, for example. So we need to make sure that those are separated. And it comes down to not only fixed assets, but also lifestyle assets. You've got that antique or family heirloom that's sitting in the house that is sort of treated like a fixed asset, but it's an asset nonetheless. And the data is different. And you can't, materially, those don't function the same way. And we need to change that discussion of what an asset is and how an asset can be used.
Yeah, absolutely. And Rob, your take on that?
Very much. I think that one of the biggest challenges with fixed assets, for example, is the liquidity side of it. So unlike investment assets where you can always sell a portion of the asset to subsidize your needs, it's not like you can go, I'm just going to sell the granny flat above my garage. So whilst on paper, your net asset value can look tremendous because of your fixed property component, other than rental income, you definitely have liquidity issues that obviously need to be considered. I mean, we're obviously getting more into the financial planning side now, but I think, as Richard said, the attributes of lifestyle assets to fixed assets to investment assets are materially different. The growth rates that are applicable, you can't take a domestic property figure for growth and income and apply it to your primary residence. It's just not relevant. So we have to ensure that the appropriate asset classes or fixed rates of return or house views, for that matter, are applied to the correct assets to ensure the most, I guess, realistic set of data that you can begin the financial plan with.
Yeah. And then on the other hand with that, and I agree with what you're saying, I think it's very important to separate these things out also, not just from an understanding like the asset allocation or the incomes and the growth rates and everything that's applicable to that, but also when you start doing planning and you want to create scenarios and you want to create what if we do this, what if we do that, understanding these things from its function and what it is, how we can use it. I think it helps in that decision making and sort of putting those things together as well. On the one hand, so it's understanding them, but then being able to use that understanding to really come up with different things that one could do in the plan that goes way beyond products and things like that. So I think from that point, it's also important for me. And then, I mean, liabilities, often liabilities are included because what we want to do on death and disability and retirement is settle those debts or have it settled by the time that we retire. But often, I know that I've done this, like a lot of times I just make the assumption that by the time you get to retirement, your house will be paid off. But I don't know that for a fact. I just know what is outstanding today. I don't even know what the interest rate is, what the repayments are. Are you paying extra on your bond? What is the remaining term? What are your plans? Are you taking more money out of the bond? I don't know. So, I mean, from a liability point of view, what do you think, Rob? What is critical from that? What is really, really critical, and what would be nice to do with liabilities? So there's what must we do, and then what are the other things?
Well, I think what we definitely do see far too often in the market is people getting to retirement age, and at retirement, a large chunk of any gratuity that they receive is utilized to settle debt. Because we tend to live beyond our means a lot of the time. We're keeping up with the Joneses. And certainly what we'd like to look at here is what is the value of the debt that you have? Is there an opportunity to look at some form of consolidation? And by that, I don't mean let's refinance your car over 20 years, not the best idea. But is it worth looking at some sort of debt consolidation? And then what sort of term would you be looking at trying to amortize that over? So have you still got 10 years to go, 11 years to go? So based on the term, the interest rate and that, the software, well, various softwares in the market for that matter, will actually calculate what that repayment is in order to meet the objectives. And I think it's a key decision factor in terms of planning. And what's also key is also to understand the relationship between the liability, the possible related asset. Now, obviously not all debt has assets related to it, but certainly the big ones like your bond, home loan does. Because if you've got your second property financed, what we also find is that some of the stats that come back to us and some of the workshops that Richard does with the team to advisors, we find that people forget. And that's what we're trying to avoid is let's not forget silly things that are so obvious, we just overlook them. So I've got a property, a second property, it's got a liability linked to it, and I may also be receiving a rental income. And then at some point, the advisor recommends that we actually sell that property and put it into an investment portfolio that is generating X return, etc. And we agree to do so. But we forget to sort out the liability at that point in time. So it's important that you also look at the relationship between assets to debt to income, so that when there is that formal relationship, such as the linked liability, the linked income, solutions can and calculators can then automatically settle the liability on asset repositioning. The income would cease because the asset no longer exists, making it much easier for you as the planner not to go, now did I remember to do that? The system just does it automatically. But it's all part of ensuring that that data linkage, that foundation is correct.
Yeah, that's critical. And I mean, we see this quite often, is that, and yeah, I think, there's a lot of planning that can, and again, the thing that keeps on popping up for me is that there's so much that we can do from this data that is not necessarily product related, but it's a lot of value added advice. It's value adding. And you can, that's real financial planning from my perspective. And, something that one would be able to charge fees for and do things like that as well. But because you have the right data, it becomes so much easier to identify those things and to give advice based on those things. We can save people a lot of money just through changing behavior or just through channeling money in a different direction as well, and really understanding what is probably going to happen if they continue down the road that they are. So that's sort of the discussion on assets and liabilities. I mean, there's so much more we can get into, and I can really keep you here for the morning. But I just want to touch on income and expenses as well. So if we can talk a little bit about income and expenses, because income is what enables any person to build wealth, to have assets in the first place. And unless you've inherited money, there's no way you're going to have assets unless you earn an income first. And then also the continuous earning of that income will help you build your asset base. And then also those assets can start generating income as well. But then also we need to understand expenses. So I want to get into these two parts and just say, okay, so where do we start with income? I mean, what is important to know about income that we have to know in terms of that? I don't know who's going to take that one. Rob, do you want to take it? Richard, do you want to take it?
Yeah, I mean, we've chatted a lot about incomes, but for me, and I've made this point a couple of times before, and not necessarily on the show, but with incomes, you need to understand where the incomes come from and what's the purpose of those incomes. So to understand, the person has an employment income, but that's not going to be taken into account generally when it comes to a retirement plan, for example. So you need to understand that income is not going to be part of the plan in retirement. And then you've got other incomes which are going to come from rental. What are the costs that go along with those incomes? So you're going to have expenses that are tied into those incomes with property maintenance and that sort of thing. And then there's varying degrees of incomes that the guys need to look at. Rob, I don't know if you want to jump in to talk about other incomes and expenses.
So I think this whole area of incomes, it can get quite interesting, especially when you get into the planning phase. Somebody has a disability claim, but is it temporary disability? Is it permanent? Would your salary continue for the period of temporary disability? The biggest issue again here is ensuring that we've got everything captured, that the data is correct, the tax nature of the income or the tax deductibility of the expense is indicated appropriately. And certainly tax nature when the source of income may be a distribution from a discretionary trust is important to obviously understand. But for me, it's making sure that the numbers are right, not the planning term so much, but the term of the income, will it continue to retirement? Is it a shorter term? Is it just going to continue ad infinitum, such as a rental income on a property if you've got no desire to ever sell that property? But for me, the biggest issue is presenting the information to the planner in a way that the planner is able to apply their mind. Hopefully they don't have to. So sometimes, well, let's not go there. To be able to apply their mind to what to use, how to use it, and when to use it.
Yeah, and from an income perspective, also, one thing that I always get, like, if you train any system, it doesn't matter which system it is, the first question they ask is, so should I put it in pre-tax or should I put it in, after tax? Is this a net amount or a gross amount? Because every system is different, and you don't understand those things. And then, okay, so let's say you have to put in the net income amounts and not the tax or not the gross amounts. What do you use to calculate that, and how do you determine that? And because I think a lot of systems would want to make it easy and just say, let's just work with net amounts. But there's a risk there of getting it wrong, and I guess the question would be like, how wrong can you be, kind of thing? Is it really that much of an issue 30 years down the line? But be that as it may, I think it's from my point of view, it's important, because also you spoke about drawdowns earlier, and we often see drawdowns as income, but how they are treated for tax purposes are very different from what an annuity, for instance, would be, or an income from rental properties, etc. So, having to understand that there's no income tax, but then also maybe, but there is definitely a capital gains tax implication. That's what Richard referred to earlier when he was saying from drawdowns, you need to understand the ongoing CGT from that point of view.
So I think the problem there is that we'd all love to keep it as simple as possible. We'd all love to go, the back of the box of a Lexington cigarettes and write a few numbers down and close the deal as completely acceptable. And it may well be at times. But the problem that any software provider has is ultimately the customers that it is appealing to. Because we have customers that are going, we just want something completely simple. We have customers that are going, but you haven't calculated the unused, the what do you call it, the roll-up portion of the retirement fund as it rolls up towards retirement, so that that's the deductible amount, that even if you're not utilizing the full value, so that you can offset it against future lump sums or against the annuities. So you kind of got these far-out requests on the right and simplicity on the left, and it's how do you marry that? It's an extremely challenging process to get right, and I don't think that we've got it right. I think that we are trying to put settings into calculators to cause them to behave in a more simplistic manner, or we design new interfaces to sit on top of the tool that has less data, less clutter, if you will, to make it simpler, maybe a little bit more intuitive for the advisor to step through. And then if they get to a point with the customer where they realize that actually this is not as simple as I initially thought it was, to be able to then do a deeper dive into a more comprehensive interface that has all the data to be able to manipulate and really drive hard. But it is very challenging on what is enough or what is too much, or because if we just put that out to the panel, sorry, not to the panel, to the guests on the show this morning, I think we'll be quite amazed at the different answers that we receive back. So one of the things that we do try to do, and this is again something to look out for, is what we call tool tips, little help, little icons. They've got a little eye next to them, usually a little information box that pops up, just gives a little bit of an explanation as to whether this is a gross or a net income, and what does gross income or net income mean. I mean, it's easy to utilize net income because we can just say, what's the value that goes into your bank account each month? But then we can't calculate the deductible amount correctly for things like retirement annuity contributions, and then we can't do that roll-up of the unused portion for the offset against annuity or lump sum in the future. And one portion of the market is happy and then the other portion of the market's unhappy because they want that detail, but these guys don't want the detail. So it's a very difficult situation. We try to cater for everything, which is not necessarily always the right thing to do, I suppose. But as I said, we try to appease everyone by having different interfaces that one can interact with, different levels of complexity, simple, running a lot deeper. And that's more on the planning side. But again, it's the data that will drive how you want to use it.
Yeah, no, I like that, having underneath. So you've got this I almost want to say like this engine at the bottom, but you can sort of choose what body you're putting on top of that. If you want to keep it simple, it's just the bare minimum, because there is a bare minimum amount of information or data that's needed to do a plan. I mean, you can have that, or you can go all out and fill in every single box that you possibly can. But by having those different sort of layers on top, you can switch if it's a simple client, in the sense of like it's really straightforward, just started working, there's nothing, no need for death or anything, is basically disability and maybe retirement. You just want to put in the basic stuff because there is nothing yet. So then you want to use that. But then you get to somebody who's maybe 45, 50, they're getting closer and closer to retirement. There's more things happening, more moving parts. And then you want to be able to take that same client and just build on the information that you've already got. So I think that's an excellent strategy and function to have, and to be able to choose as per the client, because it's actually the client that should be driving how much information we put into the system, and not from a point of view of what they offer us, just how complex this situation is. The simpler it is, the less information we need. The more complex, obviously, the more information we need. And I think often, maybe financial advisors and planners would think like, how do I approach this? And they try and fit all the clients into the same box. And I'm making a very wild assumption. Yeah, I've got no basis for saying this. I'm just sort of asking that question where maybe, and I always say this in a lot of my sessions as well, that we need to be careful that we're not putting our own views and our own sort of beliefs onto our clients, because it's very easy to do that. A simple example is if you are not a risk taker, you're going to invest your client's money always into something that's very conservative. Often it's very hard for you to take on risk. So then a client that should be taking on risk, you keep them from taking on risk because, and those things just happen naturally in our conversations, because our beliefs in the way that we view the world often seeps through to this. So it's hard to really focus on the client and put them at the center of that. So, Rob, so I'm going to call it here. We'll continue next week with all of there's a whole host of things that we're going to be talking about. So next week, I want to talk about policies and retirement funds. I want to talk about goals. And then I also want to get into trusts and the information that we need from trust, if there is a trust that is involved. So next week, Tuesday, we're going to do it same time, same place. So 8 a.m. next week, Tuesday, with Rob and Richard. Richard, any closing remarks from your side?
No, just on the goal side of things, and you've spoken about it, I think knowing your clients is key, especially through the different life stages. And like you said, they're going to drive your data, and it's to be comfortable in those stages, whether it's minimal data or it's a lot of data, to be able to move within those different life stages and understand the level of data that's needed from each of your clients.
Yep. Rob?
Funny enough, coming back to your comment around the underlying engine and how we integrate with that engine from different interfaces or complexities, it just made me think of the car industry as well. I don't have a fancy car, but if you watch some of the programs at the weekend and you listen to what they're saying, if you take VW and Audi, for example, the VW Polo and the Audi A1 are both built on the same platform, but both appeal to quite a different market, have different levels of technology and features and what have you. And that's very similar to what we're trying to do with the management of data. How do we present the data to one user in a way that they feel comfortable to use it and manipulate it, versus the presentation to somebody who's very technical, very qualified, etc., and really wants to take a deep dive. It's hugely challenging, but the good news is not just limited to financial services. The car industry has got these problems, and how do they go about solving them? And I think we're solving them in similar ways. with being able to provide different interfaces with different complexities or comprehensive detail to advisors to be able to use it in terms of how it suits them, and importantly, how it suits their customer. There's no point using a Rolls-Royce financial planning tool for your customer who retires from the railways with a pension fund and a pure endowment. But at the same time, you don't want to use the back of a box of Lexington cigarettes for your client who's got 13 different assets, 5 fixed assets, various investments, incomes from all different sources. It's just horses for courses, and it's not the easiest thing to solve. But we try.
Yes, and I just want to say, in these times, you're not going to find a box of Lexington, so it's going to be very hard. So, anyway, guys, thank you very much. I look forward to having you back next week. I'm wishing you all a safe week, and enjoy. We'll chat again next week.
Cheers. Thanks, Francois. Cheers, Rob.
Thanks, everyone.
Bye.